Hi everyone, and welcome back to the Peregrine Capital Hedge Fund Training Academy. My name's Alan Yates. I'm the Head of Distribution for Peregrine Capital, and today we're going to be running through the key benefits of hedge funds. So let me take you through 5 major benefits that I think could really benefit you and your practice. The first is flexible mandates. Now, the mandates themselves are not a benefit per se, but the fact that we have the flexibility does mean that we are not benchmark cognizant, which I think is super important because it allows us to go where we think the best opportunities are at any point in the market cycle. There's a variety of strategies on offer to you and a variety of ways for us to try and generate that excess alpha that traditional fund managers might not have the flexibility to do. They've obviously got significantly more constrained mandates, whether it's an equity mandate or a multi-asset mandate, whereas for us the lovely thing is we are able to invest in wherever we think the best opportunities are going to be in that period of the market cycle. And importantly, I think what that means is that when markets are not going the way that one would hope, we are able to protect on the downside and de-risk the portfolios quite significantly. So if we move on to the next benefit, it's about diversification and low correlation. Now, often we all talk about diversification as being the only free lunch in investing. And that's fine to say when people are talking about diversifying across asset classes. But in times of market stress, you'll often find that the asset classes start to correlate quite significantly. The appeal of a hedge fund is that we are able to get those revenue drivers to be very different in our portfolios. So what that means is our portfolios are going to look very different to the funds you would invest in traditionally, whether they're in the equity or the multi-asset space. And the appeal of that is then that our funds, relative to the other funds in your portfolio, are going to behave very differently. And I think most importantly, are going to behave very differently when markets are drawing down. As an example, if you find that the markets have a big pullback, say like in 2020 when we had the start of COVID, our hedge funds, and I think hedge funds generally in South Africa, were very well protected against that pullback because we were able to put things like derivative hedging in place, short positions in the market, etc., etc. The nice thing about this is we can then generate returns independent of market direction. So because of that bi-directional investment strategy that we spoke about last time, it means that we can actually still generate returns even when markets are trending sideways, when they are not quite delivering the type of returns you would like as an investor, or in the worst case scenario when they are falling in a bit of a heap. Final thing here from a diversification perspective is it does give you exposure to alternative investment opportunities that you otherwise might not have access to in the more traditional long-only space. These include things like special situations, index arbitrage, a variety of other strategies. Maybe there's some commodity strategy, physical commodities, etc., across various hedge fund managers. So that wider toolkit, that wider and flexible mandate does give you the benefit of getting access to asset classes and return drivers that you otherwise wouldn't get. Moving on to the third benefit for today is around downside protection. And I think this is a super important part of why hedge funds, particularly in South Africa, are gaining in popularity. So, I mean, if you think about the way we look to manage a fund, there are a number of ways to go about doing it. But for us, I think as hedge fund managers, it's kind of what it says on the tin, hedge. So it means that we need to make sure that we are protecting that downside. So often clients come to us to say, we are after the returns, absolutely. I think that's kind of just the hygiene element. Everyone wants to get returns out of their investment. But to them, the ride matters. So what that means is clients that come to us don't want to have to sit through the full fat experience of being in equity markets. Having that volatile ride, having that situation where there is a big 20 or 30% drawdown in their assets and in their portfolio. So for us, this downside management is a key component of what hedge funds bring to the table. And we implement that through various things. We chatted about the use of derivative structures last time as that sort of insurance policy in the portfolio. We also can talk about things like index shorts. And then obviously just in terms of the flexibility, the ability to look at those pair trades that we spoke about, the ability to invest in various return streams within a portfolio, that means that portfolio can still deliver good returns to you as the client, regardless of which way the market is going. Then if I move on to the next major benefit that I think is super important, is just around consistency and what that does for performance. Now, I mean, it's great to talk about diversification. It's great to talk about risk management. But at the end of the day, neither of those two things on their own are going to generate exceptional returns for your investors. But they do provide us with the ability to compound off a significantly higher base. So if you think about it like this, risk management in our mind is to say, when markets fall, if our portfolio is exposed to the full fall of that market, you as the fund manager are immediately on the back foot. You know, if the market's down 20 and your fund is down 20, you're not in a fantastic headspace. You know, you are dealing with the market in a way that might be somewhat emotional. But B, it also means that you've got to work very hard just to get back up to parity, back up to where you were in terms of break even. So if we can implement those hedging strategies and we can make sure that the correlation for our funds is low relative to the market, so when the market falls down a bit, we can very nicely engage the market rationally, look at the opportunities that are available to us, and then hopefully compound from a significantly higher base. And what does that result in? I think it results in two things. One is positive returns even when the markets are going in the wrong direction. Consistency in returns, i.e. we don't have to chase risk in order to make up for lost time. If we're able to compound at a very, very consistent rate, over time, that has a significant impact on returns. So from a risk-adjusted return perspective, our view certainly as hedge fund managers is that the hedge vehicle gives us the best ability to do that, to generate those exceptional returns in whatever risk category you're after. So hedge funds are not about simply maximizing returns by maximizing risk. They are about managing the risk according to the mandates, according to what our investors are after, but to just generate a return that is hopefully better than what they can get in traditional long-only funds. And I think that's kind of the core competency here. Now, if I talk about our high growth fund as an example, that is a fund it was the first fund to do 100 times capital for investors in South Africa. So, I mean, currently as we stand today, R1 million invested in that fund's worth roughly about 179 million rand today. So the inception number was 1 million, current number is 179. That's incredible capital creation. But it was done not because we were swinging for the fences, not because we were trying to generate a return that was 60 or 70% in any one year, but rather by protecting that downside, by giving you that consistency and just being able to compound that return over time. It has incredibly powerful net benefits for investors. The other thing about this that I think for you as a portfolio manager or a fund manager that is super important is that it means that your clients get a smoother ride. And I think the ride matters. You know, from a behavioral finance perspective, often you find clients will come into an investment with the view that they are happy to take on the risk. But when that portfolio does have a significant drawdown, very often clients capitulate at exactly the wrong time. I think the lovely thing about a hedge fund is that it smooths that ride for the client, meaning there's less risk of that capitulation at exactly the wrong time. Then if I move on to the next major benefit that I see, particularly in the South African hedge fund industry, is just the quality of managers that are available to you. So, I mean, the one thing that attracted me to this industry when I joined was that there were some really, really exceptional fund managers who had these track records that were decades of experience, and they had produced alpha consistently throughout their careers. And I think if you chat to those fund managers, the thing that always strikes me about them is they will all tell you that if they had a perfect world, they would only manage hedge assets. So even the guys that manage long only funds as well as hedge funds, you'll find that A, most of their personal capital sits in the hedge fund space because they think it's the best vehicle, and B, that they kind of went into the long only space very often as a means of scaling their business rather than because it was something that they felt was a better vehicle. So for us at Peregrine Capital, we've stuck only to hedge. And we've stuck only to hedge purely because we just think it is the best mandate or the best vehicle possible to generate those exceptional returns and those exceptional risk-adjusted returns. I think the other thing that's lovely about a hedge fund structure is twofold. One, it's a performance-orientated structure. So we will talk in one of the coming modules about fees, but one of the fee elements in a hedge fund is often a performance fee, which really just actually means that we are looking to generate the best possible return for you, because when you as an investor benefit, we benefit from the fee structure of that fund. Then the last thing to mention here is that there's an incredible alignment of interest across the industry, i.e., fund managers are invested in their own funds. So if I speak for Peregrine Capital, us as staff, we're the second largest investor in our portfolios cumulatively. So we're invested right alongside your clients, because we just think that these vehicles are the best vehicles to grow our wealth over time. And I think that tells you that should hopefully give you a lot of comfort to say that A, the fund manager's got a lot of skin in the game, B, the fund manager totally believes in this portfolio and believes in the structure, and these benefits, I think, over time are very apparent to our investors, many of whom have been with us for many decades, because they extract that benefit, they get that experience, they get the smoothing of the ride, they get that downside protection, and I think very importantly, they get that low correlation, because I accept that hedge funds are not going to be 100% of your portfolio. They're going to be a part of your client's diversified portfolio, and so they need to bring something different to the table, and I think they do that really well. So just in summary then, what have we talked about today? It's mainly about the benefits that the hedge funds can bring, and I think that comes down to those three things: exceptional risk-adjusted returns, great downside protection, and therefore consistency in return profiles, and low correlation to the overall portfolio of your clients. Thanks for joining us.